Welcome to the Asia Climate Finance Podcast, where our host and expert guests delve into and scrutinize the pressing issues and emerging trends in climate business and climate finance. We greatly appreciate your support. Please like, review, and subscribe to the podcast to help us grow and reach a wider audience. Be sure to take note of the disclaimers at the conclusion of each show. And now, here is your host, investor, analyst, and author, Joseph Giacobelli.
Hello there, and welcome to the 51st episode of the Asia Climate Finance Podcast. In this episode, we discuss from the top down an area which seems relatively straightforward, climate risk modeling, but actually is not straightforward at all. It is something that plays a fundamental role in shaping informed decisions, managing risk, and driving strategic planning by empowering businesses, governments, and individuals to understand and quantify the impacts of climate change. It is something that underpins accurate insurance pricing and investment evaluations, while at the same time guiding public policy and resource allocation. In this episode, we are joined by renowned expert Martim Rocha, the global head of risk business consulting at SAS, the renowned leading global analytics platform. Together, we explore the high-level aspects of climate risk modeling and delve into the key areas of climate risk it addresses. Martin shares his insights on data analytics, emphasizing the critical issue of data quality. He also examines the transformative role AI is playing in modeling and provides a compelling long-term outlook. Enjoy the episode. Hello, Martin, and thank you very, very much for making the time for the Asia Climate Finance Podcast. And how's things today? How are you?
Very, very well, thank you. And it's a big pleasure for me to be here and talking about this subject.
I'm very, very glad that we were able to hook up today. I know you've been traveling like crazy, so I really appreciate the time. So I'll just get right into the conversation. I've already introduced you. Perhaps a few words on SAS, because not everybody may exactly know the company that you work for.
Sure, absolutely, my pleasure. So the SAS, as we say, we typically don't say by the letters. SAS, as we say, it's a company that is now more than 40 years ago, born more than 40 years ago, so long history. But fundamentally, it's a company that has always been dedicated to produce software to support analytics. So initially we call it statistical procedures, etc. Now, obviously nowadays we call analytics, data science, AI, etc. So it's a company that has been around for a number of years. It has a very good position in the market and supports all sorts of analytics. So from credit risk, where it's actually quite successful. But also, if you talk about demand forecasting, so understanding how energy demand behaves and forecast how the needs of energy could be in the future. So electrical companies, users, banks, users, insurance companies, telco companies, also to understand the customer profiling. So it's a quite broad topic, but it's always ends up always on the question of using analytics to get results and understand better the business and the world.
Right. So part of that work is with climate risk modeling. And maybe, for those of us, including myself, who are not that familiar with what this is about, at a very high level, could we just explain a little bit what climate risk modeling actually is?
Absolutely. Yes, we are now spending a lot of time on that. It's personally, I've always been very close to the topic. I started my career working in renewable energy. So I've always been very, very close. My heart has always been close to this topic, sustainability and climate, etc. Now I have the privilege of taking care of that topic in SAS. And fundamentally, when we say climate risk, what we are talking about is the possible impacts of climate change in the risk the business is taking. So to understand what could be fluctuations in results, or fluctuations in capital, or fluctuations in the business measures impacted by events coming from climate change.
And here we're talking about both the kind of physical risk and operational
Absolutely.
risk.
Yeah, exactly. So then we divide that in a number of things. Like, for example, if you start going to the next level, you have floods, you have wildfires, you have high temperatures, you have a number of other physical events that are associated with climate change. And so fundamentally, for example, if I'm doing a mortgage in the bank and that mortgage is for a house that is in an area that is particularly difficult when it comes to floods, obviously I'm increasing the risk of my mortgage because my customer will be in risk of a flood, and because of that, he will be obviously in a riskier position compared to another customer that is in a non-flood area. So that's the kind of story, meaning understanding how those events could potentially impact the business, and then in that case, I mean, we have the physical risk, as you pointed out, where, the most typical is the flood, wildfires, high temperatures, big storms, etc. And then we have what we call the transitional risk, meaning one of the big stories is obviously the carbon emissions, that the increase of CO2 in the atmosphere, then that needs to be reduced. So there are a number of efforts to reduce that carbon emissions. And as you know, carbon emissions happen all over, meaning it's not just your car, right? It's if you are producing electricity, and if you are producing electricity based in coke, for example, then obviously you will be emitting CO2, right? So then your electricity has a footprint, meaning it comes with a certain impact on CO2 emissions. So the concept of transitioning from a society that is a lot of dependency on activities that have high emissions to a society with no emissions or very low. It's what we call the transition process, and the transition risk is the risk associated to that transition, which is more of an indirect risk, if you like, but it's quite material. So, for example, if I'm working with a company and that company, because of regulation, becomes in difficulties. Let's say the company has high levels of carbon emissions, but it's still quite profitable and it's still quite good to work with. However, regulations, let's say, make it strict in terms of emissions. The company has difficulties to adapt to the new story and lower their own emissions. Then they become a risk for me, right? So then that's the kind of story that we are talking about when we're talking about transition risk, is how society is progressing on transitioning to no emissions, low emissions. There's obviously economical impacts on that, either because of regulation or either because of competitiveness, so on and so forth. Now, There's the obvious examples like, the oil companies will be affected. Yes, that's obvious, but there's a lot more to that. I mean, pretty much every company will be affected in one way or the other, and understanding the profile on how these companies will be affected is key to understand, obviously, what we call the climate transitional risk.
Right. But whether we're talking about physical risk or transition risk, the base at the end of the day is the data that is available for someone to assess the level of physical or transition risk of a counterparty, of a company, or whatever.
Definitely.
So in terms of this data analytics, two quick silly questions, simple questions. One is, where does the data actually come from, and what about the actual quality of the data?
Well, that's actually the biggest challenge, right? Because in terms of analytical tools to then calculate the impacts, we are well equipped as a world, right? Obviously, SAS, but not only. I mean, we have a number of statistical processes, a number of AI processes nowadays that can actually, with the right data, produce a good result on measuring the risk. So, as you pointed out, the bottleneck is on the data, meaning if you don't have the right data, you can have the best analytical model of the world, but it still doesn't work, right? So fundamentally, the question of data is the big challenge that companies are now facing. And the point there is that typically statistical processes work based on historical data. So we look at historical events, and then from there we derived what can happen in the future, right? So by analyzing trends, analyzing patterns, analyzing how the numbers fluctuate across, etc. Now, if you don't have a good historical series of data, it becomes very difficult for you to understand how it will evolve. And now the question comes in twofold. First, we are talking about climate change. So the rise of the temperature, for example. So obviously, it's something that we anticipate will happen in the future, but hasn't happened yet. So how do you model to a scenario that has never happened, right? It's a little bit about it's a little like the pandemic. When the pandemic hit us, everyone was saying, "Okay, now I need to understand what levels of risk I'm facing now in the pandemic." But you don't have historic because the pandemic never happened before, right? So it's similar to that situation. However, obviously, you try to look at historical events and say, okay, now the events are a bit more extreme, but they are somehow similar to events that happened in the past. So let me make that association. However, then it comes the second challenge, which is that not that many countries in the world have recorded climate-related data. So, for example, temperature. I mean, Europe, US, yes, we have series of recording temperatures on a daily basis, or even lower than that, for nowadays almost 100 years, right? In some countries less than that. But if you look globally, there are a lot of countries where that data has never been registered or has never been registered in a reliable form.
Right.
Second aspect is the grid, meaning the granularity. I mean, I can record the data in one point, but I have to be conscious of the geographic of the story, right? So if I'm recording the data at a hill, it's not the same as recording the data in the valley, right? So the granularity of that data, it's another challenge. And I'm talking about temperature, but you could talk about the flood records on flood, where the flood hit, how, what areas, the wildfires, and so on and so forth, right? That's a challenge because we don't have yet that data being collected, organized, cleaned, related to the usual data, so that we can make those calculations. Because fundamentally, it means that think about your house is like having a climate ID of your house. Where is located regarding floods? What is located regarding wildfires? What is regarding tornadoes and others, right? You don't have that idea of your house or that idea of your business, right? So that's one of the key aspects, because we really need that data in order to be able to make the calculations. Then obviously we have the analytics part, because these are typically sparse events, which means that we have to use analytical techniques directed to this kind of approach, which is not exactly the same thing when you are looking at something that has a good amount of events, and therefore you can more easily create the analytics.
How do you actually, really, really tough questions, which I'm guessing the answer, but I'll ask anyway, which is, how do you actually address the fact that there's just some data that you won't be able to have, or just some data which has got quality issues? And I think on the quality side, you're saying about the pandemic. Well, actually, the world did see pandemics before, but we've got no recorded data of them.
Exactly. So we go to the same problem, right?
Exactly. So do you design software so that you can fill in the gaps, or how do you address that?
Yes, exactly. So there are a number of techniques, and now with the whole thing around artificial intelligence, obviously we actually have the contribution from that discipline as well. But you have to interpolate data, for example, to calculate points in between other points. You have to use the more now advanced imagery techniques to define the exposure to certain events. So there are a number of techniques that we can use to complement the data and to increase the data. But those techniques can improve, right? And they will definitely improve. However, there is always an element of uncertainty associated with when you do that. Those algorithms have associated with them a certain level of error, right? So I can interpolate between 2 points, but I know that whatever I do when I interpolate will have X deviation, right? So in that sense, yes, I can use a number of techniques to improve the quality of the data and to actually relate the data to each other and augment. But I'm also augmenting the level of error of my result.
Right. Yeah. The more assumptions you make, obviously, the greater the scope of error. I used to be an equity analyst. I used to make financial modeling of companies, and I learned the hard way that the more assumptions you make, the more likely you are to go down the wrong path or the wrong road. But you did mention already the kind of golden 2 words, which is artificial intelligence, AI. Could we talk a little bit about AI. I was reading the other day, I think in Nature magazine or somebody, that they were saying the kind of climate, the actual climate modeling, AI will actually improve climate modeling quite significantly in the very, very, very short term. So obviously, AI is going to have a huge amount, a huge role to play in climate modeling. But could you just briefly talk a little bit about that?
Sure. I mean, it will improve there as it improves in anywhere else, right? But yes, particularly because I mean, if you are doing the traditional credit risk analysis to understand probability of default of your customer, and you are doing that in a mature country where you have a lot of history around defaults, maybe AI does not bring much value because the traditional statistics, considering the richness of the data, will do the best, right? Now, as we were mentioning, in climate risk, there is a challenge on data. And so the added value of techniques like AI obviously come as a great benefit. And fundamentally, the idea is that you can see beyond the usual regressions and the usual statistical processes that rely on a certain very well-defined logic of the data, right? I mean, if I'm doing a regression, I know that I need to have a time series with constant intervals to then derive that regression, right? But in AI, I can be a bit more flexible on the data that I use to feed the algorithm, right? So I can get some other insights, like AI can give me patterns that says in these conditions, typically this will happen, right? So which brings other factors to the table that I might not be thinking about. Again, in traditional statistical techniques, you have to define the dependent the dependent and independent variables upfront, right? In AI, you can simply say, "Oh, there's this database with lots of different points, and tell me which factors you think influence the results more, let's say, with a bigger weight, right?" So in that sense, it gives us the ability to do a more unstructured modeling. Maybe unstructured is not exactly the right word, but I don't have to plan ahead exactly the type of analysis I want to perform. I can be a little more, let's say, unstructured, and then obviously I can bring a lot of different factors at the same time to the analysis. So I can analyze a higher number of possible factors being possible to influence.
So we talked about climate modeling, Martin. So how is it used by financial institutions, by insurance companies, by corporations? Are there many differences or similarities in the ways that financial institutions or corporations use climate modeling?
I mean, there are, again, it relates to their core business, right? Obviously, insurance companies have been looking at what we didn't call climate at the time, but insurance companies have always looked at, let's say, extreme events as one key element of their business. So they were already looking at the flood areas as one factor to determine the price of the insurance. or understanding that if, for example, my house is next to your house, then there is a cumulative risk, meaning even though we are two different people and we hold two different policies in the company, the company was assessing their cumulative risk, meaning if I, as an insurance company, if I'm insuring a whole neighborhood, it's different in terms of risk or of insuring houses spread across the city, right? So, and this, just to relate, for example, if there is a fire, then obviously the whole neighborhood would be affected, or earthquake, etc. So they wouldn't call it climate at the time, but they've been doing that kind of modeling already for many years, right? Now they adjusted and say, okay, now let me look at this from the climate risk perspective, and so let me complement with a few other things that maybe I was not looking at before, that now I should in face of climate change. So for them, it's fundamentally evolution of what they're already doing, right? Whereas in banks is more new, right? It's part of the same fabric in the sense that it's about understanding the risk, credit risk, for example, understanding the impacts on credit risk. So my mortgages, my personal loans, my credit cards, etc. Understanding the impacts that might have on the credit risk, and some of the traditional factors used on credit risk that are related to, for example, unemployment or GDP or some other factors. Now you have to bring new factors, right? So it doesn't change fundamentally the way companies operate, but it brings complexity, and obviously it brings new source of data, new modeling techniques to incorporate. Now, if you leave a little bit the financial services, then the story is a bit different, because obviously in big corporates, maybe climate change was something completely out of their mind, and now becomes a more prevalent thing associated with that, because in reality we are talking about climate risk, but when we talk about risk management, we have now climate risk, cyber risk, resilience risk, third-party risk, a number of non-financial risks that 10 years ago were not material, and now they are all material, right? Now, obviously, the focus today is about climate risk, but I'm just giving that perspective that it's one between a number of non-financial risks that suddenly jump to the front line. And in corporates, for example, now these risks are being monitored in a completely different way they were 10 years ago. So there's a clearly a raise on the discipline of risk management in companies, in particular if the companies are exposed globally.
Yeah, I've actually been a little bit surprised. Well, I shouldn't be, but I was still surprised that, because of the pandemic, corporations should have learned about the kind of supply risk.
Yeah.
And the supply risk was caused by COVID, obviously, and the side effects. But climate at the end of the day is the same thing, right? So if, I'm exaggerating, but if a port where major export port is flooded or, is unusable because of climate change related reasons, then all of a sudden, your supply chain is affected. And it still seems that people have very, very slow to take up the problem. I guess, talking about that, do you think you could illustrate how climate risk modeling actually works maybe using, a couple of examples, 2 or 3 examples. Of course, there's no need to mention institutions or countries or whatever, but just a couple of more practical examples to illustrate this.
Sure. I mean, so when it comes to financial institutions, climate risk can manifest in fundamentally 3 aspects, either by affecting credit risk, as we somehow already discussed, either by affecting market risk, meaning the investments, portfolio investments that a financial institution might have and how they would fluctuate in value depending on climate-related events, and fundamentally, and third, the operational risk, how it impacts operational risk. So, which is more the direct impact of climate risk on the institution itself, right? So, if my financial institution is working in certain areas, my business is in areas that are more, let's say, risky related to climate change events, obviously, I can be directly affected, not through my customers, like in credit risk, or through the market, like in market risk, but actually directly in my institution, right? So there are these 3 aspects on how climate risk typically affects financial institutions. Now, financial services institutions. Now, for example, when it comes to credit risk, typically there are 2 things that banks are now modeling and taking focusing specifically. One is what I was discussing before, the probability of default. So how climate risk can affect and change the probability of default of my customers. And the other is also, if you think about that in many loans that a bank has with customers, that they are guaranteed by a collateral. Obviously, you need to look at the value of those collaterals, and particularly because in many situations those collaterals are the house that is part of the mortgage or any other physical collateral. And obviously, physical collaterals are typically could be highly affected by climate events, right? Climate change events. So these are 2 obvious elements where you have to assess the PD, the probability of default of your customers in light of climate change events. You have to look at the collaterals that your customers are bringing in to support the lending. Then you have to look at the profile of the companies that you are investing. So if you have bonds of a certain company, if you have equity, etc., what is the profile of that company when it comes to emissions, when it comes to their physical climate risk, those kind of things. So these things are happening. And for example, on the market risk side, there are a number of companies that today publish scores on corporates related to climate risk, so that when you are investing in the market, you actually have some idea of how that company positions itself on climate risk. So, I mean, the typical companies that publish ratings are now publishing ratings and scores for the ESG and climate risk, and that is being incorporated in financial services companies to manage their portfolios. And then finally, on the operational risk side, obviously, companies are doing their own assessment on what is their exposure. So their locations, what is the position, geolocation, and how that could potentially affect the way they operate. So, for example, every company, especially listed companies, have now a footprint in terms of carbon emissions, and you want not only to manage your carbon emissions, so you want to make sure that you have a plan to lower your carbon emissions, but also if you have a portfolio, you want to understand what is the plan of your customers to net zero, for example, right? So companies are now not only collecting the carbon footprint, but also collecting the plan the companies has to net zero, and in that sense, obviously, this brings a lot of new activities in data that is being collected when you are, let's say, submitting for a loan. Now, depending on the size of the loan, obviously, but most probably you will be asked for a number of elements that would be related to climate risk or ESG in a more broader aspect. That is happening, and companies are contracting in the market data so that they can complement the internal data to be able to. I mean, we discussed the challenges of data, but it's evolving. Meaning every day there is new techniques and there's new elements on how data is being collected and quality of data being improved. So obviously companies are trying to contract the best supplier for data, and then obviously incorporating that in their processes and analytical processes to do the calculations, as I was mentioning.
I'm just curious, as just to supplement that with a question, to clarify that with a question. If I'm a real estate company, for example, I'm a developer, and I develop commercial buildings and residential buildings, and all of a sudden I decide that, well, not I decide, I'm forced to start thinking about climate risk. And then I call you and your team, and SAS comes in. Maybe I've collected a little bit of basic data before, but I'm not, it's not an area I'm very familiar with. So how long is the process of, you and your team kind of explaining to the company all of the elements that they need to measure? And it's obviously not something that they can do overnight. Is usually the lag time quite substantial, or it can be done fairly quickly, if you know what I mean?
Well, it depends a lot on where you are located. So one key element is that today it's quite heterogeneous. I mean, if you are located in Sweden, you might get access to data very quickly, and then I can help you to model the impacts, because the whole market in Sweden has evolved and has been investing in this area already for a number of years. So the government has been collecting data, private companies have been collecting data. They've been relating that data across, and so I would be in a much better position to help a company that is located in Sweden with my modeling software than located, for example, let's say in Guatemala, right? The reality is the world is quite heterogeneous in that aspect, right? Obviously, companies tend to be exposed to different markets, and that would complicate the story, because I could be dealing with a company in Sweden, but that company might have activities or factories in Bangladesh or something, and then suddenly we have a big challenge, right? But that's an important factor of the story, right? Now, typically, I mean, the way we work is obviously to first to understand what is the current position, but more importantly, where we focus to help companies is more on projecting their business to the future and understanding how different scenarios of evolution related to climate change may affect their future. So, for example, if temperature rises by 2 degrees in 10 years, would that affect your business or not? And if it does, how? Right? So modeling that story, right? Obviously, there are a number of different scenarios, not just the 2 degrees. There are a number of other factors that should go into the scenario. But fundamentally is helping companies to understand how their business will be affected in the future for climate change and how they could find the best route to net zero. So there are a number of ways that you can go net zero, right? I mean, you can sell all your cars and buy electric cars and claim that you are zero emissions, which is not completely true, by the way. But anyway, but the point is that there are a number of ways that you can get net zero, especially a bank. If you think of a bank that has a portfolio of customers, the bank going net zero means all these customers going net zero. So you have to combine different portfolio management approaches. Like, I mean, I will start lending more to this profile and lending less to that other profile, because I know that if I lend more to this profile, then I'll be getting to net zero quicker, right? Or align with my targets. Actually, maybe it's a better picture. I have a plan, and I need to align how we evolve my portfolio with my plan. So that's the type of things that we've been working with our customers, not just on the modeling specifically of the impact, which obviously we are, because I mean, when it comes to PV modeling, I think we are fundamentally the world leader on software, meaning most of the world banks use still SAS to do that. But so obviously that's one aspect, but we are trying to get to the next level, meaning how you can simulate your business across time in the future and understand in face of different scenarios of evolution, how your business would be affected. What would be your margin? What would be your levels of capital? What would be your emissions profile at that point, so on and so forth. So not just the climate change, but obviously climate change in face of my usual measures.
If I can maybe wrap this up, Martin, with one kind of outlook question. If you had a crystal ball, how do you see climate risk modeling evolving over the next 25 years? And I do appreciate that the whole software business is not exactly very long term given all the changes. But if you were to guesstimate over the next 25 years how things are going to be evolving, what would be your guess? What would be your view?
I think there are two aspects. One is obviously the modeling techniques will evolve quite a bit now that we start understanding how to use things like generative AI in the process, right? Traditional AI was somehow already embedded, at least to a certain extent, but more and more now we have the challenge to understand how to take value from Gen AI. Which is not obvious, by the way. I mean, people are saying that change everything, etc. But let's see, it needs to mature. But obviously, those new stories, I mean, Gen AI combined with the other techniques, the computing power, because one of the key elements of when you do any type of analytics is to have computing power. If you have computing power, you can do more simulations to a more granular level, right? And that gives you more detail on analysis and can spot patterns that otherwise would not be spotted, for example, or trends or that otherwise would not be spotted. So obviously the computing power is one key element that will help to evolve the process. I think will be, when it comes to climate risk, it will become completely obvious in the process. Meaning today, if I tell you that in order to provide you a loan, I need to assess your credit risk, you wouldn't be surprised. I mean, everyone assumes that, right? Now, I think in 25 years, climate risk will be as usual and as normal as credit risk or others, right? It's one piece of the risk management story that one needs to consider. And financial statements that today tell you what are the company levels of capital, the profits the company had, so on and so forth, will have side by side what is the company's emissions, what is their plan to net zero, how they behave in a number of climate risk related measures. So I think fundamentally we are in that process of understanding and how this should be part of the daily life, and in 25 years it will be, let's say, something that is side by side with everything else that is part of, let's say, the routine, if you like.
Right, just completely embedded and part of the normal process of doing business.
Like I mean, it's, if you think about a small element. Now, if you buy a house, you look at the energy efficiency certificate of that house, right? And you think, this one is maybe not as efficient. Or if you buy an appliance, you look at the energy certificate of that appliance, and you take that in consideration when you make your buying decision, right? 10 years ago, that wouldn't be at all. 20 years ago, no one would ask what is the consumption of an appliance, right? So my point is that it will become the same way that the energy certificate is now completely embedded on appliances, houses, and a number of other physical elements. Climate risk will be embedded on our activities.
And we can also guesstimate, not forecast, guesstimate that the actual collection of the information will be easier because, again, it will be part of the business, and also that the quality of the data will sharply improve, again, just because you're using better methodologies to collect the data, right?
Yeah, better methodology and better physical aspects, because think about IoT, right? IoT can now improve how you collect data at the edge, right? And meaning that you can start collecting more data, and that would improve the quality, right? Again, goes back to the storage capacity, the computing capacity. So the combination of those factors, computing capacity to collect data more often, more regularly, and on the edge, together with people being more acquainted that they should share and collect this data, then obviously will increase dramatically the quality of data, or contribute to increase the quality. And then obviously once you have a mature level of data quality, then the analytical techniques will shine. I mean, they will shine, right? They will be able to do much better and provide much better results.
Right. That's this was a really fantastic conversation, Martin. I really appreciate your time again. I know you've been traveling quite a bit. I hope you can get some rest now that you're back in Lisbon and enjoy Lisbon's wonderful weather.
Yes.
So again, thank you so much for this very, very interesting conversation.
Well, my pleasure to be here. Really nice conversation. And yes, I hope that I can go on holidays now to enjoy the summer because it's been quite a hectic first 6 months.
I'm sure you'll be able to get some rest. So once again, thank you so much.
Thank you. My pleasure to be here. Really nice.
Thank you for listening to this episode of the Asia Climate Finance Podcast. Please be advised that this podcast is presented for educational purposes only. None of the information provided should be construed in any way as investment advice. Always consult with a licensed investment professional before making any investment decisions. Additionally, please note that the views and opinions expressed by our guests are personal and may not reflect the views and opinions of their current or previous employers.